Welcome, everyone. Thanks for joining today. This is Angie. Nice to see you all virtually. I guess you can see me. I cannot see you. I do not have my counterpart, Alexandria, today. She is taking a few days off, so I'm running the show all by myself. So welcome. I've got everybody muted. We will have ample time at the end for any questions that you may have. In the meantime, if questions come up during the presentation, please drop them in the chat box. I'll address those first, and then certainly we'll open up for anyone else that wants to chat. So thanks so much for joining Compliance Corner. Our topic today is ACA reporting. So I'm going to turn off my video, and let's go ahead and dive in. ACA reporting, also known as IRS reporting, has been required since 2015. Believe it or not, there are still clients who realize they did not file, or maybe thought they filed but actually didn't. Truthfully, the IRS is still open for business. They are still accepting filings all the way back to 2015. To determine whether or not you are required to file, essentially employers with a self-funded benefit plan of any size and an applicable large employer. That means you have 50 or more full-time equivalents. Now, you certainly have to count if you have multiple businesses, you have a common ownership in multiple businesses. There are a lot of rules around that, but you do have to add all the employees together if you have multiple entities. So again, self-funded, regardless of size, and ALEs, which are 50 or more full-time equivalents. So you must report to the IRS information about the healthcare coverage, if any, that you offered to benefit eligible employees. Employers also, of course, must furnish the statement to employees, which is the same information that gets transmitted to the IRS. Now, although employees don't really need to do anything with their 1095 form, employers still must give it to them. The only responsibility of the employee is to maintain that in their tax records. Now, if you want to dive into the Internal Revenue Code, feel free. It's IRC 6055 for our self-funded plans and IRC 6056. So the main difference between the 6055 and the 56 is obviously self-funded versus not self-funded. But when you look at the rules around self-funded plans, again, this is an employer of any size. So you can have less than 50 employees. If you have a self-funded plan, you must file. When it comes to self-funded plans for filing, you must include dependents that were enrolled, COBRA participants, and retirees if you are sponsoring a retiree plan. With the 6056, it's more so our fully insured groups over 50 full-time equivalents. When you're fully insured on your benefit plan, the carrier is responsible for reporting to the IRS on your dependents and COBRA participants. So main difference. So if you've had a situation where you've had an employee come in and say, hey, I got 2 IRS forms, and you take a look at them, one's a 1095B and one's a 1095C, if you have a fully insured plan, the B form came from the carrier. The C form, of course, came from you, the employer. Now, I always say when the Affordable Care Act came out, it really changed the verbiage that we've been using forever, which is the distinction between full-time employee and part-time employee. Essentially, the ACA changed our terminology to more benefit eligible versus variable hour. So important distinction to make there. I get asked probably at least 10 times a year, is this going away? The answer is no. It's probably not going to go away ever, if at all. Even though it was part of the Affordable Care Act, it was shortly thereafter moved into what's called the Trade Preferences Act, and obviously deeply rooted in the IRS. The IRS has also spent well over $1 billion with their software in order to accept this data. Data is king in the world we live in today, and the IRS is collecting more data about businesses, about individuals, more than they ever have before. So I would really find it hard to believe that that's going to go away anytime soon. Some things to be aware of. Because we've been required to file since 2015, if we fall into the proper categories, please know that IRS audits are coming out like crazy. I've not yet seen an audit for a 2018 filing yet. I'm still seeing just as far as 2017. So the IRS has a ways to go to get caught up in typical fashion. But their audits are coming out rampantly. And I believe they delayed a little bit due to COVID and everything else going on, but we are seeing them coming back out yet again. Just wanted to pop here for you, and certainly when we send our thank yous for attending, we'll have the slide deck and the recording available to you so you can refer back. I wanted to just share on this slide the affordability percentages. They do change every single year, and just recently 2021 affordability percentage has come out. So 2019 to 2020, we went down a little bit. Now for 2021, we're going back up. So please keep in mind that this percentage changes every year. It could go up or it could go down. Now, we talked a little bit there for a moment about audits. Two particular audit letters that are coming out are the 226J and the 5699. The 226J is in response to an audit, or I'm sorry, a filing that did occur where the IRS is coming back and saying, here is your proposed employer shared responsibility penalty payment. And that is generally for not offering to at least 95%, perhaps not offering minimum essential coverage, not being affordable. So that's your typical A and B penalty that we've all heard about from way back when, formerly known as the sledgehammer penalty and the tackhammer penalty. This is a real example of someone that received a 226J penalty. They have about 4,600 employees, and the fine was almost $7.7 million. All we needed to do to assist them in responding to get this corrected is a checkbox on the 1094C under Part 3 that, yes, they are offering minimum essential coverage. Once that was corrected and sent back in, the IRS came back and said, thank you, your estimated penalty is now 0. So a lot of times, if you ever see a 226J letter, essentially the IRS is giving you the absolute worst case scenario for penalty. So please make sure that you respond to them quickly. My advice is always, the very moment you get that letter, there's a phone number printed on the first page. Call the IRS, ask for an extension of time to respond. They will give you automatically an extra 30 days to respond. And sometimes that's needed if you have to go back through your files, do some due diligence and some research. It takes a little bit of time. The bottom right corner of your screen is an example of a real client that I worked with. They received a 5699 letter. We call the 5699 a phishing letter. Essentially, the IRS is saying, hey, Mr. Employer, you look to be like an applicable large employer, and we don't see that you have done your filing. This bottom right corner snippet is essentially after that first 5699 letter. If the client did not respond or the employer did not respond, the IRS is going to then send a second letter with your penalty. This contains two penalties, actually. This is failure to file and failure to furnish. So failure to file means you did not file with the IRS, at least they're not seeing it. Failure to furnish means if you didn't file, we're going to assume you also did not prepare 1095 forms and distribute them to your employees. So this is like a double-edged penalty here. Now, the way they calculate this penalty is they take the number of W-2s for that tax year and times it by whatever the current penalty rate is. In this situation, I believe it's $260. Now, that's for failure to furnish. And you'll notice they use the same calculation method, which is the number of W-2s times the penalty amount. But the failure to file is just a little bit higher. And why is that? It's because they charge you the number of W-2s plus 1 in the failure to file section, plus 1 for good measure, apparently. But keep in mind, even if you did neglect to file, as I said earlier, the IRS is open for business. You can still backfile. So not a terrible thing. You can still backfile. But also, if you get a letter like this or the penalty amount like this, keep in mind that, again, the IRS makes assumptions and gives the worst case scenario. They count the number of W-2s, but in essence, in order to calculate what your true penalty should be, it's not necessarily the number of W-2s, but the number of benefit eligible employees. So if you have some part-times, you have a variety of different things. You have some temporaries, you had people who come and go throughout the year. This is the worst case scenario. So even if you do have to pay a penalty, make sure that you're seeking support and advice on how to calculate what that true value should be. So again, I've seen penalty letters only up to the 2017 year, so they are still plugging away. If you have seen our other communications regarding the IRS in July, kicked out the draft of the 2020 1095 form. So what I did here was I essentially took a side-by-side for you, and I apologize, part of the word draft is on my 2020, but what I wanted to show here is the one codes, which are the offer codes for 2019 in comparison to 2020. Now, we've said all along, the IRS has the entire alphabet to work with these line 14 codes, which are the offer codes again. Well, in true IRS fashion, we will now have 1A through 1Z for our codes for 2020 on the 1095 forms. Now, 1T through 1Z are listed as reserved for future use. Whether the final forms, once they're issued, change any of those things from 1T to 1Z, it's hard to say, but they did certainly add a lot of codes. Essentially, they added from 1L all the way to 1S. So pretty big difference this year from prior years in what has been adjusted for the next filing forms. Very interesting stuff. So in normal fashion at Navigate, we love to create our little grids and flowcharts and things like that. How do you get to the various codes? Well, we've published a chart like this before and had kicked that out. We will certainly include that. This is just snippets of them. We will include that in our thank you as well, just so you have the full copy. If you are brave enough to work through your own codes, wonderful. But if nothing else, it's great to have a little bit of insight. So when you're reviewing forms to view for accuracy and things like that, it would be nice to kind of know, how do we obtain these codes? How do we get to this line 14 code for every employee for every month? So if nothing else, this would be helpful to just let you know how we get there. Because we have a variety of new codes, we added to our roadmap in order to essentially break down what does the flow chart look like for all of these new codes. Well, the interesting thing with the new codes, and if you had received our short video regarding the draft forms and individual coverage health reimbursement arrangements, that's what we were talking about. So I'll review that again quickly for you. Essentially, the new concept of a product called an individual coverage HRA, which was launched towards the very end of 2019 and became effective and usable as of January 1st of 2020. Now, there is a whole presentation around these ICHRAs, but to give you kind of the Cliff Notes version of that is an employer can utilize this new type of vehicle to basically fund a health reimbursement account for employees so that the employee can use that money towards their medical expenses, towards premiums on the individual marketplace. Now, the goal for this is to use something like this as a bit of a benefit incentive for small groups who do not offer group medical plans, but they want to do something for their employees. Or it could be for an employer who has a benefit plan in place, but also has a big population of, let's say, part-time employees who would never be benefit eligible, and they want to do a little something for them. So there's a lot of rules around it, but essentially because it's being delivered as a group type of offering, the IRS wants it reported on. Now, as I mentioned, we did a short video about individual coverage HRAs. You're welcome to go take a look at that if you haven't seen it on our YouTube channel, which is called Navigate HCR Public. You can go ahead and take a look at that. It dives a little bit deeper. But for the purpose of this presentation, just wanted to show that the drafts of the 1095s, the major changes are due to the individual coverage HRAs, and we have provided a bit of a flow chart to help you navigate through how to use which code if you offer one of these individual coverage HRAs in your business. And then, of course, we revamped the line 16 or the 2 codes. Again, we'll provide all of these to y'all for your reference to use at your leisure. Let's talk a little bit about state-based reporting. Now, we all have lived in the world of we've got to do our ACA reporting to the IRS. This is a federal requirement. We talked about the rules. But what you may not realize is so far, 6 states have successfully passed their own statewide individual mandate. Now, if you remember, when it comes to the federal individual mandate, which was there in the very beginning when the ACA was passed, a year ago, 2 years ago now, gosh, time flies, I'm not even sure without looking, but they changed the individual mandate penalty down to 0. So when that happened, states started scrambling to say, okay, look, we can't have a situation where the residents of the state are gambling with their insurance, not getting any, or perhaps they don't have group benefits. So they saw the need for an individual mandate at the state level. So states are starting to implement that. When a state implements some sort of individual mandate penalty, what happens is they need to report on that. They need to know what is going on with all the individuals. So they lean on businesses who have employees, whether they're full-time, part-time, temporary, seasonal, doesn't matter. These are another segment of the population in that state that the state can now get information on to determine whether somebody owes a penalty for not having coverage, whether it's individual coverage or it's group coverage. Essentially, that state is saying, I want every individual within the state to have some sort of medical coverage, regardless of where they get it from. So far, 6 states, California, DC, Massachusetts, New Jersey, Rhode Island, and Vermont have all instituted a statewide individual mandate. Now, Massachusetts has been doing this since 2006. So if you're on the line today or you're listening to the recording later and you're from Massachusetts, you all have been going through this for quite some time. So all of these particular states, and we're going to cover them in a little more detail in the upcoming slides, but the next 5 states, these are states that are actively considering and or pursuing this. So something to look to the future on. Connecticut, Hawaii, Maryland, Minnesota, and the state of Washington are all looking at starting some sort of individual mandate, which means shortly thereafter they will come out with their specs on ACA reporting. Let's unpack this a little bit. Again, Massachusetts has been doing this since 2006. For DC, this is new for them. So employees should receive their 1095 January 31st, which is normal, same with the feds, and March 31st, filing to the state. For 2019 reporting, which is due in 2020, they gave a little bit of an extension to June 20th. Now, every state you're also going to find is different in their rules and requirements. So I'm not going to go through this super deeply because I want to make sure that we have time for questions at the end. Again, you'll have all this provided to you. But just know that when a state starts requiring state ACA reporting, every state's going to be a little bit different in what they need to fulfill that filing. So at this point with DC, they have some specific formats and layouts. So you need to take a look at what Washington, DC is requiring. Again, I'm doing just a high level here today. New Jersey is going to be the same. Forms due to employees January 31st. And filing to the state March 31st. Now, what New Jersey is saying, the requirement really is for self-insured groups, where so far DC and Massachusetts, they're not specifying just self-insured. They're saying all employers with group benefits need to report. New Jersey says, I only care about the self-insured employers right now. They want your submission to go through the New Jersey system platform that you would use for your W-2 forms. Now, they're also saying fully insured plans should be filed by the insurance carrier, but the New Jersey website says, please don't assume that that's absolutely correct. Please contact your carrier and confirm whether or not they are filing, because if the carrier says, no, we're not doing it, then you as the employer would need to do that. Now, 2020 reporting that's going to be due in 2021. Vermont, their website is still showing pending. They do not have any specific info or requirements posted yet. California, forms will be due to employees January 31st of 2021, and filing to the state March 31st of 2021. Again, that'll be 2020 reporting due in 2021. California has been so gracious as to say employers may send the same 1094 and 1095 forms to the IRS. They should be publishing some information about electronic submission sometime in October of this year to let us know. So again, if you have employees that reside in California, you need to be aware of this. Rhode Island, same thing. Their first reporting is due in 2021 for filing year 2020. They're also being gracious and saying that employers may send the same 1094 and 1095 to the IRS. So far, out of the 6 states, at least 2 are allowing you to use the information that you already provide to the IRS. Here's some things that I really want you guys to consider, because granted, sending the same information to the state that you give to the IRS is a good deal and will certainly make your life easier until you break it down a little bit. If you think about what you're required to file with the IRS for ACA reporting is benefit eligible employees. If you have an employee that was benefit eligible even one day of 1 month throughout the filing year, you need to report on it. We're adding another layer now with the state, because the state wants you to report on employees who were not necessarily ever eligible for benefits. So you've got a lot of part-time folks that you probably need to now do some work on reporting for them just on the state level, where you don't need to do that on the federal level. You also need to be aware, if you have employees who reside in any of the 6 states that we mentioned, you need to file with that state for that employee, regardless of whether the employee is full-time, part-time, or whatever. And again, it's not really based on where you, the business, is domiciled. It's based on where your employees reside. So be careful of employees who reside in those bordering states that are near the 6 that we talked about. Again, it's going to be very important to review the rules for those individual states, because so far they're not saying too much about only employers of certain sizes. You know, they're not saying anything like that really at this time. And if you are a smaller employer who may be just skirting the line of 50 full-time equivalents and have not had to file previously with the IRS because you weren't quite big enough yet to meet their ALE rules, you're now going to have to report to the state unless that state comes out with specific size criteria rules. So be very cautious of some of these new little tidbits that we've got going on. And then the other thing to be aware of is, does your vendor, if you use an external vendor to do your reporting, are they going to support state-based reporting, or are they only handling federal? So something to be aware of. At Navigate, we're working diligently with each state to make sure that we have some sort of connectivity or inside information with their rules and criteria based on what we do at Navigate. The other thing to be aware of is, if you've done your own reporting, if you're small, you're under 250 W-2s, and you've done your own forms and mailed them to the IRS every year, you know, just be aware that this is another layer yet again for you. As states look at implementing some sort of individual mandate, we will keep you posted, but as they do that, they're going to, within at least a year, want some sort of reporting. Because again, whether somebody is going out to the individual marketplace, getting a tax credit, things like that, the IRS wants to know, should they have provided that credit, or, you know, should we penalize an employer? Should we take back that credit from the employer and then penalize the employee? You know, when the IRS gives out money, they don't give it out freely, and there are always a lot of hoops to jump through. So, new information. It's going to be an interesting couple of years, I think, going forward. So with that, thank you guys so much for your time. I would love to take any questions. Now, I have you all muted, but you are now able to unmute yourself should you like, or feel free to use the chat box, and I would be happy to answer any questions. Again, this was pretty high level. We will have way more information to impart about individual state reporting by each state as we get that information from the state. We'll dive a little bit deeper into it for you. All right, I am seeing no questions, so I'm going to give you guys a couple more minutes because, you know, I'll just keep chatting. Say hi to our team in this world of virtual presence. It's always fun, I think, to see some faces. And if you've talked to any of us, this will give you a little bit of an idea of who we are. It's always good to put a face to a name. If you're not following us on social media, please do so. That also includes our podcast, which drops the first Tuesday of each month. Any previously recorded segments that we've done or webinars are out on our YouTube channel. You're absolutely welcome to go grab those at any time. They are public, free. Go ahead and take a look. And as always, thanks for hanging out with me today. Sorry you missed Alexandria today. She's taken a couple days of vacation with her family. But I am happy to have spent some time with you guys today. Don't forget to join us next month for yet another new fun and exciting compliance topic. Everybody have a fabulous rest of your day, and we will talk to you next month. Thanks, everyone.